Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 27th, 2026. Hey, how you doing? I hope you're having a nice weekend. I hope you had a good trading week, and I really appreciate you coming to my weekend review podcast. I really do hope you're going to find it helpful. So last week, very interesting week in the markets, really quite a tough environment, a tough trading environment in the last 3 weeks. Um, I've struggled a little bit, haven't done as well as I usually do, but still had some good trades as well, and I'm going to show those to you. But, it's a good reminder of, there are certain weeks, certain months of the year where it is difficult. If you're using a good trading process, even if you're, using a great trading process, it certainly doesn't guarantee that you are always going to have profitable days or profitable weeks or even profitable months. So, if you have a process, you're following it, it's not working for you in the recent past, don't get discouraged. These things happen. Just stick with it over time. Having a good process uh, over time with an edge will get you the money. But in between, it sometimes can be a rocky road. And so for me, the last few weeks definitely have been difficult. So anyway, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to take partial profits if the market moves in the direction that I want it to, uh, what trailing stop level is, what that means, and how I execute that, and then ultimately how I am going to exit the trade either with a win or a loss. So we'll talk about when I entered, why I entered, and most importantly, really how I am going to manage the trades going forward. And this week, like last week and the week before, I did get stopped out of a lot of trades, but that is just part of trading. You wait, you're patient, you wait for the signals. They either work or they don't. It's not your fault. But the most important thing is that you follow your process. So after we go through all the trades and the open and closed positions, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and then to follow the plan. It seems easy on paper, but when the market's moving, news is coming out, it makes you second guess things and question things. But at the end of the day, the skill in trading is to follow the plan, position size correctly, and follow the plan. So it's always helpful for me to teach trading psychology. I hope it's helpful for you, and I hope you're going to get something out of it. So after that, did go down through my master watch list last night, and I have identified some potential trades next week that I'm potentially interested in entering. They're coming into some confluence of support levels. They're not there yet. Had they been there and triggered, I probably would have already taken the trade, but they're within striking distance. So I'll explain to you what I'm looking for. I'll explain to you what levels I'm looking to reject. And hopefully that will be helpful for you to get an idea of how I kind of strategize during the weekends for the upcoming week and which trades that I'm taking to look. And so if you find anything of value in the podcast today, I really would appreciate it if you could hit the thumbs up button. Really helps out the channel, lets YouTube know there's some valuable content here. And it's free and easy. Just hit the little thumbs up button. So, all right, well, let's get the U.S. legal disclaimer out of the way, and then we'll come back and we'll get started. So hang tight. Thanks a lot.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding through that with me, and let's get started. So, uh, good trade that I had last week. I'm still currently in the trade. Is a short position on the QQQ, and I use a lot of different indicators as far as entering my positions, either to the long side or to the short side. Bullish order blocks, bearish order blocks, major moving averages. And generally on this podcast, I kind of focus on the bullish order blocks, which you can see this green box here is a bullish order block. Well, there's also something that is a bearish order block, and this is the red. So I'm just going to quickly give you a breakdown on the two of them. Let's start with the bottom one. Let's start with the bullish. The bullish is that you have to have it starts with the swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So this bar here on May 12th is a swing low. So that's number one. Number two, you need to have a swing high. A swing high is a high that has a lower high to the left and a lower high to the right. So now we have a swing low, we have a swing high. After that, you need to have another swing low that is lower than the first swing low. And this qualifies here because this has a higher low to the left and a higher low to the right. So we have a swing low, we have a swing high, we have a lower swing low. Once you have those in place, then in the future, if you go above the swing high, now you've changed market structure to the upside. And as soon as that happens, the lowest closing bar before the market structure change is your order block, your bullish order block. So in other words, if the price then in the future comes back down into this green area, this is kind of the buyable area. And you can see it was correct. From there, we bounced. So that's a bullish order block. And generally, most of my trades are bullish trades. However, this particular trade was a bearish order block. And a bearish order block is the opposite. We start with the swing high, then we have to have a swing low, then we have to have a higher swing high. And then when we have that, if in the future we go below that first swing low like we did here, now that changes market structure to the downside. And so when you have a market structure change to the downside, I want to be looking at shorting rallies back to the bearish order block. And once you change market structure to the downside, the highest up bar close before market structure change to the downside is your bearish order block. So if prices come back to this area, that is the shortable area. Now, there's multiple ways to enter a bullish order block or a bearish order block. For instance, in a bullish order block, you can get in with a rejection of the high of the order block. You can get in with a rejection of the low of the order block. You can get in with a rejection of a major moving average inside the order block, or my own custom level. And it's the same with the bearish order blocks. And so I entered, oh, sorry, I just want to make this easier for you to see. I entered a short position here on the 22nd of June at 373.77. Why? Well, in this case, we rejected the bottom, or yes, the bottom of the bearish order block. You can see during the day we went in the order block, but then closed back below the order block. That's a rejection of the bottom of the order block. So my stop on this particular trade would be a close above the top of the order block. And my end bar stop, my emergency stop is 2 ATR. So let's just do it in order. So why did I enter the trade? It rejected the bottom of the order block. In addition to that, we had a bearish V1. A bearish V1 consists of two bars, bar 1, bar 2. Bar 2 has to go above bar 1's high, but close below the close, which is exactly what it did. So as soon as I enter a trade, and in this case, I entered because it was a rejection at the bottom of the order block and it was a bearish V1. So as soon as I enter, the very first question I have to ask myself is how many shares am I going to either buy or to short? And it's very simple. I just take 1% of my total trading account. Let's just say I have a $100,000 trading account. 1% of that is 1,000. If I have a $200,000 trading account, 1% is 2,000. Then I look to the value of the 2 ATR, whatever that is. At this moment, it's 35.14. So I take the value on the day that I want to make the trade, whatever it is, and that would tell me to buy 28.45 shares. So it's perfect. By dividing your maximum allowed loss by the 2 ATR, the 2 ATR is basically telling you what the volatility of the market is. So if the market volatility is higher, I'm going to buy fewer shares, or I'm going to short fewer shares. If it's lower, I can buy more shares or short more shares. But this tells you exactly. So again, the reason I entered was rejection at the bottom of the order block. I position size, as I just mentioned. As soon as I enter the trade, I have to refer back to the 2 ATR value that I did the math with. And I place that number above my entry. Because if I have 28 shares and it moves up against me 35.14 shares, how much have I lost? 1,000. That's my maximum allowed loss. But the good news is that that only happens about 5% of the time. The other 5% of the 95% of the time when I have a losing trade, it's not going to be because of my emergency stop. It's going to be because of my end of bar stop. And on, see, my end of bar stop is right here at 739.70. So why did I pick that instead of the top of the order block? There's different stops you can use. But when you have a V1, a negative V1, a bearish V1, halfway of the washout bar, the number 2 is the washout bar, halfway of that, you're going to have inherent resistance. So that is my stop, 739.70. So in my end of bar stop. So in the future, if it closes above 739.70, I'm out. And so this gives me a very good risk to reward ratio. If the next day it had closed above that halfway of that V2 bar, I simply would have got out of the trade. I wouldn't have lost 1%. I only lose 1% of my account if it goes way up here. So maybe I lose 0.1% or 0.25%, right? So it's all about risk to reward, about entering basically as close as you can to where your end of bar stop is. So there we go. We have a bearish order block. We rejected the bottom of the order block. On top of that, we have a bearish V1 to the downside, which gives me a very good risk to reward ratio. Place the emergency stop 2 ATRs above, end of bar stop, close above halfway of that washout bar. Okay, now on this short position, as soon as I enter the position, I want to place my trailing stop level. And because I'm short in this particular trade, I take my entry price minus the value of the 1.5 ATRs. Now this is a short trade, so it's going to be below me. So 1.5 ATRs below me is this line here, 714.40. So if in the future I get down to this level, if I get to that level, it doesn't mean I do anything. It just means now, because I'm short, in the future, if I have a close above a previous day's high, I'm going to exit half of my position because it's moved very nicely my way. I don't want to let it move all the way back up. So usually I talk about long trades. This is a short trade, but it's just a reverse. So place my trailing stop level 1.5 ATRs below. So everything I've talked about so far, as far as the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. So in other words, if the market moves against me somehow, I need to take some action. But I don't want to just play defense in my trading. I also want to play offense in my trading. And the way that I play offense in my trading is I take a partial amount of my position off if the market that I'm in moves a certain direction in my favor each day. So I'm currently short the Qs. So let me show you exactly how I'm going to do that. It's very simple. I simply take, because remember, I'm short this trade, I simply take the closing price. Right now, the closing price is 706.52. And now I look to the value of the 0.45 ATR. Right now, the value of 0.45 ATR is 791. So I simply take the closing price minus 791. My first profit target for Monday is 698.61. So let's just write those in there. 698.61. There it is. There's my first profit target below me. If on Monday we get to this level, I will take off 10% of however many shares I have going into the day. If I have 100 shares going into the day and I get to that first profit target, I'm going to take 10 off. If I have 500, I'm going to take 50. And I always place 3 profit targets. Okay, so closing price minus the value of the 0.45 ATR gives me my first profit target. My second profit target comes from taking the first profit target, 698.61, minus again the 0.45 ATR. Second profit target, 690.70. You know what? I think I put in a wrong number. I'm going to do these again. 606.52 minus 791. I thought that looked a little off. No, that's right. 698.61 minus 7.91, 690.70. Oh yeah, I thought I put a wrong number in there, but no, it's correct. Okay, that's my second profit target. And to get my third profit target, again, second profit target, 690.70 minus 791, 682.79. Okay, so there's my 3 profit targets for Monday. The first one at 698.61, second one at 690.70, third one 682.79. So if it goes down on Monday and hits my first profit target, great. I'll take 10% off. If it really goes down, maybe I hit the second profit target. If it really goes down, maybe I hit the third. And the whole idea with the profit targets is offensive, taking partial profits when it moves in your direction. So you can lock in that profit, reduce your overall position size, which reduces your overall stress on the trade. Now, because I shorted and I got to trailing stop mode, that means because I'm short, in the future, if I have a close above a previous bar's close, I'm going to get out of half the remaining shares. So Monday, if we close above Friday's high, I'm going to get out of half. All right. So that's the offensive part. So let's just kind of take this trade, starting it all over. Why did I enter? We have a bearish order block up here. We rejected the bottom of the bearish order block. We also had a bearish V1 to the downside. This was a lower high short, which is always better than a higher high. You can see these highs were lower than this high. So I entered here, 737.33. I position sized as I just showed you. Placed my emergency stop 2 ATRs above. If it gets there, I lose 1% of my account. My end of bar stop is simply a close above 739.70. Why? Because that's halfway of the V2 washout bar. So it's a good risk to reward ratio. If I'm wrong, I placed my 1.5 ATR trailing stop level below. And what happened? Next day, went way down. Hit multiple profit targets into that move, which was good. Reduced my position size, locked in those profits. And on that very same day, I got to trailing stop mode. Next day, down even further, hit another profit target on the move down. Next day, we gapped way up. I thought, well, I'm going to have to get out of half because it looks like it's going to close above the previous bar's high, but it did not. It closed below it, so it kept me into the trade. Friday, moved down again, got to hit another profit target on the move down. So this has been a really good trade. We are coming into the bullish order block area here, so I wouldn't be surprised if we bounce here. But again, see, when you're in a trade and you get to trailing stop mode and you have multiple profit targets, then a lot of the stress is off, because I just know now if it closes above Friday's close or next week it closes above the previous bar's close, I exit half. So it's a good position to be in. This particular trade actually is doing quite well. It's up 4.41% on this short position based upon the bearish order block. So those are the cues. CRM is a position that I got into on Thursday. I got in here at 150.10. So question is here, why did I get into this trade? Well, multiple reasons. Let me refer back over to this bar here that I've highlighted in blue. This is an abandoned baby. I know, kind of a funny name, but why is it called an abandoned baby? An abandoned baby consists of 3 bars, bar 1, 2, and 3. Bar 2 has to gap down from bar 1's closed. You can see this is bar 1, bar 2, gap down. So overnight, the sentiment was bearish. However, the very next day, we gapped up. So from bar 1 to bar 2, we gapped down. From bar 2 to bar 3, we gapped up. This is called an abandoned baby. This is a very sudden shift in sentiment from bearish side to the bullish side. And when that happens, there's a lot going on under the hood there. But suffice it to say that when that happens, there's some dynamics going on in the market that makes it more bullish than bearish. Now, I don't usually buy immediately on an abandoned baby. I just don't. I wait for somewhat of a pullback, maybe to the top of the abandoned baby or something else. So I didn't buy on the day that it triggered the abandoned baby. Then the next day it went up, I didn't buy. But I did buy here on the 25th when it had a bit of a pullback. And multiple reasons of why I bought here. Number one, you see the negative third ATR channel. This is this thick gray line. This is a very key level. And on the day that I bought, during the day we were below it, but then we closed back above it. So in other words, we rejected the negative third ATR channel. That is one of the reasons. The other reason is we pulled back into the abandoned baby. I mean, really anywhere in this abandoned baby after the gap down and the gap up is kind of a bullish area. The third reason that I bought it is this megaphone trend line. And so a megaphone trend line, basically, you take a swing low and then you have another swing low. And actually, I just went over this with one of my students, Charlie, and this is what directed me to this trade, because we were talking about it in the lesson. We were talking about megaphone trend lines, and I believe he's the one that caught this trend line. So thanks, Charlie. But a megaphone trend line, you take a swing low, and then in the future, you look for a lower swing low, and you connect those two bottoms, 0.1, 0.2. A lot of times, if you then get to 0.3, you'll have some kind of bullish reaction there. So if you take it all together in the aggregate, we had a bullish abandoned baby. We have the third point of the extended megaphone trend line pretty close below us. So, I can't guarantee that it's going to bounce at the third ATR channel, but made me feel better about the trade. We're in the low RSI levels. This is also helpful. So that's why I took the trade. So I took the trade at 150.10. Now, the majority of the time with the majority of my trades, I take partial profits, as I mentioned to you on the Q short. I go into trailing stop mode. I have the end bar stop. I have the emergency stop. So the majority of my trades, I do this. But when it comes to abandoned babies or island reversals, I like to change things up a little bit on this particular kind of entry. And so when I enter, I position size 1% on my account divided by the 2 ATR. That's my emergency stop down there. If in the future the price comes down and touches that, I'm out of the trade. How much have I lost? I've lost 1%. Okay. However, to the upside, I place a 4 ATR profit target. And this is the green line here. And now I'm just going to let this trade go. I am for sure, I mean, I don't know when, but certainly for sure in the future, it's either going to come to here or it's going to come to here. If it comes here, I lose 1%. If it comes here, I make 2%. So I have a good starting entry with the abandoned baby, the rejection of the negative third ATR channel, the low ATR, the low RSI, the close proximity to the third touch on a megaphone trend line. And if I'm wrong, I lose 1%. And if I'm right, I make 2% on my account. So this trade has started off pretty well. It did bounce right after I bought it. And so this particular trade is up 5.22%. But like I said, I'm not going to do anything with this trade unless it hits my emergency stop for 1% loss or hit my 4 ATR profit target for a 2% gain. Just let it go. One of those things are going to happen. Hopefully will be the latter, and it will get to my 4 ATR profit target. But we'll see. But off to a good start, up 5.22%. Okay, Microsoft is a trade that I took on Friday. And so a lot of things going on here. You see the green box here. This is an order block. And, you know, there's two types of order blocks that I use. The majority of the time, I use a full order block where you have the swing low, the swing high, the lower swing low, the market structure change. Okay, there are times where I use a half order block. A half order block does not have the swing low, swing high, swing low. It essentially has a swing low that in the future takes out a swing high. So here's a swing low, here's a swing high. You can see we broke above that swing high. Okay, so now the lowest bar before it broke out of that swing high becomes a half order block. I don't like them as much as full order blocks, but if something at the moment is happening inside a half order block, I take a look at that. And since we're over here, let me highlight, because this is part of the trade, let me highlight these two bars here in the blue. We just talked about abandoned baby. Abandoned baby is when you gap down and then you immediately gap up with one bar. You can have the same situation where you gap down but then move sideways for one or more bars and then gap up. Then it's called an island reversal. So this is an island reversal. You gap down, you had a day of sideways motion, and then you had a gap up, kind of leaving this like a little archipelago of islands here. Well, when that happens, the high of that the high of the island reversal is a support level. And that support level here is 364.57. So keep this line in mind. And so let's go into the future here. So what happened on Friday? Obviously, Microsoft had a big move up and a lot of things happened. We rejected the bottom of the half order block for sure, right? We were below it, we closed back above it. Also, there was that key level of the high of the island reversal at 364.57. We went above that. Additionally, Thursday we were below the 30 RSI. Friday we closed above the 30 RSI. So that's a deep dip buy signal. So we had a lot of confluences. We had an under 30, over 30. We had a rejection of the top of the abandoned baby of 364.50. We had a rejection of the bottom of the order block. We had a rejection of the negative third ATR channel. The previous day we closed below it, and then we closed above it. So a lot of stuff going on there. So I did enter the trade at 373 on Friday. So I position size, of course, I placed my emergency stop 2 ATRs below as always. My end of bar stop on this one, I chose the top of the abandoned or the island reversal from the past here at 364.10. 50. Why? One, that's a key support level now. And two, it is halfway of this big up bar that we had on Friday. When you have a big up bar, generally you will have some kind of inherent support at the halfway. So I entered right here, 373. My end of bar stop, 364.57. Next week, if we close back below that, I'm out. Of course, as always, I place my 1.5 ATR trailing stop level above. And if it starts to move up on Friday, I will take partial profits if it moves the value of at least 0.45 ATRs. If it doesn't go up and go down, I don't do anything. As long as it closes above 364.57. So this trade is exactly even at the moment, and but I like it. I like the trade, and we had a V2. Bar 1, bar 2, bar 3, 2 goes under bar 1's low, 3 closes above bar 1's close. So a lot of confluences there. Even with all the confluences, doesn't mean it has to work, right? But I was patient. I waited for the trade. This is a completely AAA rated signal, and obviously I hope it works, but I don't have any control. The only control I have is staying in this thing as long as it closes above 364.57 and knowing what to do with it, and if it closes below, getting out. So those are the three positions. Qs, the short position, currently positive 4.41%. The CRM position currently positive 5.22%, and the Microsoft position break even. Okay, let's go to the closed positions that I have. So this was Carnival. This was a really, really good trade. I did exit it here on the 22nd of June. Not because anything technically that did, it's just that it was the day before earnings, and I never hold through earnings. So when there's an earnings date, I know I'm getting out whether I'm up or down on the trade. But let's go back in the past and look again of why I got into this trade. So this is a green order block. So this is a bullish order block. So let's find it. Swing low, swing high, lower swing low, market structure change. As soon as the market structure change happens, it's the lowest closing bar before the market structure change. This is the key area. I bring this into the future. And the idea of this is that, this was the order block. Here we broke above this swing high. This turned us into bullish. And then we really moved up quite high. And so really the way that I look at the order blocks is I know the order block formed here. Now the price is up here. Is it safe to say that smart money was buying here when a few weeks later you're up here? And I would answer yes, 100%. I mean, in hindsight, it's pretty clear that smart money was buying here when it moved all the way to here. So the thinking is, if this was smart money before, if in the future you come back down to this order block or smart money area, does it have to be smart money again? No, for sure not. Things can change, but I've been trading for over 30 years. More times than not, when you come back to the previous smart money area, it's smart money again. So that's the thinking. So swing low, swing high, lower swing low, market structure change, defines the order block, defines the smart money area, bring it into the future. And you can see, as soon as it came back to the smart money, that's where it bounced. But I entered the trade here on the 19th of May at 23.88. Why did I take the trade? Because we rejected the bottom of the order block. During the day, we went below the order block. At the end of the day, we closed back in the order block. That's a rejection of the order block. So I got long 23.88. I placed my emergency stop 2 ATRs below. My end of bar stops a close below the order block. I'm basically right there to begin with, so it's a very good starting risk to reward ratio. I placed my 1.5 ATR trailing stop level above. The next day, takes off like a rocket ship. Hit multiple profit targets into that strength. Also got into trailing stop mode that very day. Next day, we didn't do much. Next day, we didn't do much. Next day, we moved up, took some profits into that strength. Next day, we moved up significantly, took multiple profit targets into that strength. Remember, I'm in trailing stop mode. And then here on the 1st, June 1st, we had our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of my position for a gain of 13.05%. Then we moved side, but I still have half the position. Then we started to move sideways, not a lot of stuff going on. Here on the 9th, we had our first profit target. We had another profit target, Then we had to move back down. Next day we moved up, sold into that strength, multiple profit targets. Next day moved up again, sold into that strength, profit targets. Next day gapped much, much higher, hit multiple profit targets into that strength. Then we came down next day again, while it was very bullish and moved up, hit multiple profit targets into that strength. And then I closed the position here on the 22nd for the simple fact that the next day were earnings. And so that was the end of the trade. And the remaining shares that I had at that level when I exited was a gain of 20.97%. And then you can see it was a good idea that I got out because on earnings it went down. But really the whole key here, like if we kind of look at this big picture, this is the whole idea behind trading. I entered here with a rejection of a key level. If I was wrong, I could be wrong very small. If the next day it closed below that, the low of that order block, I simply could have gotten out of the trade for a very simple, very small loss. But instead, I had this huge gain. So it's asymmetrical risk to rewards, risking a little at a key level to potentially make a lot. And that's exactly what happened. So this is a good teaching example of basically trading in general, good risk to reward ratio with the possibility of a big trade. Excuse me. And this was a big trade, a gain of 20.97, but I am now out of this trade on CCM. All right, that was a good trade, but silver was not a good trade. So I've been in silver for quite a long time. Let me take you back to why I entered this trade. You heard me talk about abandoned babies. Well, I did enter this trade. I bought this all the way back in February for two reasons. One, we had an abandoned baby. We gap down, then we gap up. Okay, abandoned baby. In addition to that, we were in the order block and then we closed above the order block. That's a rejection of the higher the order block. So the confluence of the trade was a rejection of the order block and a bullish abandoned baby. Now, when I use abandoned babies, like I mentioned before, I put a 2 ATR stop below. So if I'm wrong and hit it, I'll lose 1% on my account. And then I place a 4 ATR profit target above me. So I'm risking 1% of my account to make 2% of my account, and I just let it go. And for sure, we don't know when, but for sure, I will either lose 1% of my account or make 2% of my account. Well, the trade started off very nicely, moved up nicely. Problem is it didn't get there yet, then came down, moved sideways, and then it was kind of all over the place. We started to rally again. But what happened this week, really, with the collapse of silver, what happened, I got to my emergency stop. And as a matter of fact, a little more than 1% because it closed below or it gapped below my emergency stop, which can happen. So this particular trade, percentage-wise, was horrible. It was 32.51%. Now, I didn't lose 32.51% of my account, thankfully. I mean, I lost a little over 1% of my account. But that's why the position sizing is so important. So anyway, this was a bad trade. But put it in perspective, a week ago, 10 days ago, I had a position where I did hit my 4 ATR profit target. So I can be wrong twice and right once, and I'm even. Does that make sense? So anyway, not a good trade, did not work, but the key takeaway here that I position sized in advance so that I knew what my maximum allowed loss was, and I did hit it. So loss of 32.51%, but in reality was just a loss over 1% of my account. So that was not a good trade. All right, oil, USO. This was also a losing trade, not a big one. I did take the trade here on the 18th of June at 114.78. You see there's the green order block here. And again, with order blocks, I can get in with rejection at the bottom of the order block, rejection at the top of the order block, a rejection of a major moving average, major moving average inside the order block, or a custom level. And at this point, I had a custom level, and the custom level here was 113.30. So let's go back and see what that custom level was about. This bar is a big up bar. If you have a big up bar, inherently there's going to be some support at halfway of the big up bar. Okay, and this was also your order block as well. So that was my custom level, 113.30. So in the future, if the price came down to this bullish order block and rejected this key level of 113.30, the halfway of the big up bar, that would be the structure of my trade, and that's where I would enter. That's exactly what I did. I entered here on the 18th of June at 114.78 because it rejected the key level, closed back above it inside the bullish order block. Key level was rejected inside a key level of the order block. So I entered 114.78. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. And the next day, what happened? It closed below my level. What did I do? I got out of the trade. It was not a big loss. It was a very small loss. Let me do that again. Do it this way. There we go. It was a 1.65% loss, but the takeaway here was, okay, it was a good entry. It was a rejection of the key level within key level. It just didn't work. I got out. But am I glad I got out? Yeah, obviously. See, that's the problem. It's never fun to take a loss, everybody. But if you take the loss and then you go lower, it makes it a lot easier, right? So, um, so by me getting out with the close under that the key level, the next day if it had closed back above, I could have got back in the trade. I could have, but I didn't because it didn't happen. And we have moved much lower. But I saw the trade. I saw the rejection of the levels. I position sized correctly. Next day it closed below. I got out. That's it for a loss of 1.65%. And then Amazon. All right, well, Amazon was kind of a bummer too. It was a tough week. All right, I took Amazon on the 23rd of June, right here at about 234.11. Why? Well, this is not an order block, but let me bring your attention to this gray line, which is the 50-day moving average. When the 50-day moving average crosses over the black line, which is the 200-day moving average, that's called a golden cross. And generally, this is a bullish moving average crossover. However, in all of my experience of trading, over 30 years of trading, what I have noticed is that generally when you have a golden cross, generally the market moves down, at least short term. Long term, yes, it can be a positive moving average crossover, but in the short term, in my experience, it usually moves down. Well, it's exactly what happened. I remember the news. Oh man, Amazon had a golden cross. Woo-hoo-hoo. My thinking was it's probably going down. It's exactly what happened. But one thing I have noticed in all my years of trading is that when you have a golden cross, when you have a 50 that crosses over the 200, in the future, if you come down like you usually do, if you reject the 200-day moving average, it generally has a strong reaction there. That's exactly what happened. I took the trade here on the 23rd because it rejected the 200-day moving average, the first rejection of the 200-day moving average after the golden cross. So I entered here at, let's see, at about 234.11. I placed my emergency stop 2 ATRs below. My end of bar stop was simply a close below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above. Next day, took off like a rocket ship. And this is a good example of I hit two profit targets on this day. Am I glad I took them off? Well, yeah, sure, I did, because the very next day it closed below my stop. It closed below the 200. So taking those partial profits, those two partial profits on that up day, mitigated the loss that I had because I locked in at profitable levels part of the position, 20% of the position to be exact. And so that helped mitigate my loss to the downside. So this was a losing trade. I had to get out, loss of 3.03%. So out of that trade, and like I said, yeah, tough week. I had some good trades, had some bad trades, but overall it's been pretty difficult. And I also had to exit a trade on my weekly McDonald's trade. So these are weekly trades. Every bar here is a week, and I kind of had a lot of. I was kind of excited for this trade because McDonald's had sold off so dramatically, but we had an order block from the past, and we had a major moving average. In this case, we had a 200-week moving average in the order block, key level within key level. So I entered here 276.39 with a rejection of the 200-week moving average. I placed my emergency stop 2 ATRs below. My end of bar stops are closed below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above. The next week moved up. Grateful that I took a profit target when I had it. Next week was down a little. Next week, closed above the 200, kept me in the trade. Next week, moved up, thankfully, took a profit target while I had it. Next week, started up, closed down, and then this week I had to get out of the trade. Why? Because it closed below my end of bar stop. It closed below my level. So I had to get out for a loss of 2.54%. On the bright side, there was a dividend of $1.86 that I did receive, so that also helped mitigate the loss even further. So anyway, not a great week of trading. Had a lot of stop outs. Actually, for the last few weeks, I have a lot more than I usually have, but that's just the market. And listen, everybody, it's just normal. Doesn't mean you're a bad trader. Doesn't mean your strategy doesn't work. It's just this is part of it. I mean, it'd be nice if we made money every day, every month, every week. But in trading, it's just not realistic, right? We have to take the bad with the good, and sometimes we're going to have. But don't let that dissuade you and get you down for the coming months, because I've been doing this for 30 years. Everybody, there's an ebb and there's a flow to it, and right now it's just kind of an ebb. Hopefully, we'll have some flow. We'll see what happens. All right, before we get on to next week's potential trades that I'm looking for, let's talk a little bit about trader psychology. I was looking through my trading psychology posts, and I found this one from a long time ago, 2022. And I said, oh, this is from my very good friend, Ava. Ava is a great friend of mine now. She's just such an amazing person, really, one of the most amazing people I've ever met in my life. And she was a student of mine. And I noticed that she had made a post here, I guess basically over the things I had taught her about trading. And I saw this, I said, these are great. So this is what I want to highlight to you today. And you can follow Ava at Presence Trades over on X. So let's see what Ava had to say. She's very presence minded in her thinking, and she brings that into trading. So she wrote, stay present. Focus on the process, not the results. I mean, this is just good trading psychology, good trading wisdom. Focusing on the process is much more important than focusing on the results. If you focus on the process, the results will come. If you focus on results, that's when you lose money. I don't know how to explain it, but that is. So number one thing, really stay present, focus on your process. Number two, keep an open mind. The market can change direction at any time, and it really can, everybody. When you go into a trade like, oh, this is going to be a good trade, it has to be a good trade, it's a great setup, you're going to be disappointed. I just on the McDonald's trade, I felt very confident about that McDonald's trade, but I was wrong, right? But I do keep an open mind, and you should keep an open mind. Just because something looks great, it's a great signal, it doesn't mean that it has to be a winning trade. That's why you have to have your emergency stops. That's why you have to have your end of bar stops, and you have to follow them. So keep an open mind, everybody. The market can change direction at any time. Number three, embrace any outcome before entering a trade. So true. You really have to be okay with the idea of the outcome is your worst case outcome. In other words, your outcome is your emergency stop. You have to be okay with that number. If you have $100,000 and it's a 1% stop, and you're, even though it only happens 5% of the time, you really have to be at peace with the fact that you may lose 1% of your account on that trade. And if you're not really okay with that, you have to trade smaller. But embrace any outcome before entering the trade. It could go up, it could go down, and you have to be good with all of it. Focus on setups with multiple confluences of signals to put more odds in your favor. Okay, that shows you that she is my student, because that's all I talk about, right? Focusing on multiple confluences, not just one signal, multiple. The more you have, the more likely you're going to have, like Ava says, it puts more odds in your favor. Again, even with all the odds in the world, you could still be wrong, but we're in a statistical game. We're playing the odds, and by focusing on confluences, it improves your chances. So she says, focus on setups with multiple confluence of signals to put more odds in your favor. Number 5, only go for trades with well-defined risks, at least a 1 to 2 risk to reward ratio. In other words, if you're risking 1, you want to be able to make 2. You want to have asymmetrical risk to reward. So for sure. And if you have an emergency stop, you do have a defined risk. Next one, know where your stop is prior to entry. For sure. When you're going to get into a trade, you should already know where your emergency stop is and where your end of bar stop is. Two things very important, and you got to adhere to them. Last, take partial profits into strength. 100%. That's what I do every day with my 0.45 ATRs, right? All the rest of the stuff, the emergency stop, the end of bar stop, going into trailing stop mode, defensive moves, taking partial profits into strength, offensive. Just like any sports team, you need to play offense and defense. And the last, do not let a profitable trade turn into a loss. And you have to structure your trade to avoid this. That's why I go into trailing stop mode. That's why I take half off. If you do that, very rarely are you going to have a positive trade turn into a negative trade. So anyway, it was fun seeing this post from Ava. Like I said, amazing woman, really amazing in so many ways. Feel very fortunate for her to have been one of my students, and now one of my very good friends. So thank you very much. And again, you can follow Ava at Presence Trades over on X. Good post, Ava. Really good post. Okay, so here are what do I have? I have 8 potential setups for next week. Now, I mention this every week, everybody. All 8 of these hypothetically could trigger on Monday. Does that mean I would take all 8 of them? 100% no. I don't care if I have 10 trades that trigger on Monday, 20 trades that trigger on Monday. I'm going to narrow it down to the very best trade out of all of those candidates. And so how do I do that? Well, I have to analyze the quality score of the trade. For example, if one trade has 1 entry signal, but another trade has 2 entry signals, well, I'm probably going to take the one that has 2, has a higher quality score, has a higher report card. But things get tricky sometimes, because maybe you can have 3 or 4 really good entry signals, but maybe the stocks run a ton. And so therefore you don't have that good of a risk to reward ratio, right? So now I have to back some things out of that. I also like to look at higher time frames. If I'm trading the daily, I would maybe want to look at the weekly, see if I get some kind of signal, some kind of rejections of a key level there to help to strengthen the trade on the daily based upon what the weekly's doing. Relative strength is also important to me. I want to look at that particular day compared to the market. Maybe that particular maybe the market was down this day, but this particular trade was up. So it had more strength than the rest of the market. I would give it added bonus points for that. But, you know, that's what I do. I analyze every day and try to come up with the best one. This is how I trade. This is what I teach my students. And if I could just take a couple minutes and do a quick plug for my service, I do teach traders all over the world. I have for many, many years now, closing in on 10 years that I've been teaching students all over the world. And I teach them my trading approach. And I do that in a one-on-one course. It's a 20-hour course. I teach 10 lessons. Each lesson is 2 hours. So we do 2 hours a week for 10 weeks. So we spend a lot of time together, which I think is really good because you spend it over 10 weeks. You see a lot of different moves in the market. And I teach you all of the different trading strategies that I use, all of the different rules. We do a lot of simulation trading. I ask a lot of questions. It's very important to me that my students understand what I'm teaching them, and I make them prove to me that they do understand. But it's hugely important that my students succeed. I generally get a lot out of pleasure out of seeing my students succeed as traders. And that's why I got into teaching in the first place. And I teach students from absolute beginners all the way up to the hedge fund level and everywhere in between. So I teach you all the processes, all the rules. We do a lot of analysis together. And I think the best way to learn anything is one-on-one. 100% I do consistently. And when you're done, you're going to have a skill that you can use the rest of your life. The course is $2,000. So I know it's a lot of money, but it's an investment in you and in learning the skill. And, if you become my student, I absolutely will teach you everything I know, and I'll give it 110%. And by the time you're done, really, I think you'll have a lot of skills that you can use. Um, so if you're interested, my email is in the link of the YouTube video. Just send me a email and we can get the conversation started. But I'd love to have you as my student. Another option, if you like online courses, I have a really good online course available at udemy.com. In that course, I teach you the deep dip buy stock trading strategy. It's a great course. I've sold so many of them around the world. I think it's like 4.85 stars out of 5-star rating. And really met a lot of people through that, and a lot of feedback of how they really like the course. And if you're interested in that, it's between $30 and $50. And that course is available at udemy.com, and the link's in the description. So if you'd like to do the 20-hour one-on-one course with me, just send me an email. If you like the online course, just click on the link in the Udemy course in the YouTube video, and it will take you. But either of them will teach you a lot about trading. And again, love to have you as a student. So I hope to hear from you. So, okay, thanks for letting me put in my little plug there, and let's get back to what I'm looking at next week. So I have some good ones here, really, that I'm looking at. First starts with Apple. So Apple's interesting because we have the bearish order block above here. If the price were to come back to here, I would be looking to short. However, we are back in a half order block with a key level. So remember, the half order block is not the swing low, swing high, lower swing low market structure change. It's just that when you have a swing high and a swing low, and then that swing high is taken out, that creates the half order block. So I took the half order block here, ran it into the future. And you can see clearly the people that were buying here at this half order block, what did Apple do? It just took straight off. So when Apple was up here, can you look back and go, oh yeah, smart money was buying this dip? Well, yeah, clearly they were. Well, look, we are back in that smart money area again, right? So this is where I would expect it to bounce. And well, look, it's exactly what happened. But I didn't take the trade yet. But I'm just highlighting the area here. Now, Friday, we rejected the high of the order block. I could have taken the trade there, but why didn't I? Because the risk to reward's not good. I didn't take the trade on the 25th with the rejection of the bottom of the order block, although technically it would have been legitimate. and it did work, but I didn't take it because I took another trade on that day. So I'm monitoring Apple closely because this green box is kind of a key buy area. But I put my own custom level in here at 277.46. Why? Well, it goes back here to where the half order block was formed. We have a V2, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low, bar 3 closes above bar 1's close. The natural support level on a V2 is going to be halfway of the number 2 bar, the 277.40 level. That's why I placed the level inside that order block. So going forward, I didn't take the trade. 2 signals, I didn't take it. But if Apple does pull back and reject this 277.40 level, giving me a good risk to reward ratio, I would definitely consider entering Apple there. But again, I didn't take the trade on Friday because, yeah, it rejected it, right? Here we closed below it here. But again, back to me having to take points away with the bad risk to reward ratio. And this is a bad risk to reward ratio. So I'm just going to watch Apple and see if we can pull back to that 277.40 level and reject it. And if we do, then I'll potentially enter the trade. And my end of bar stop, my line in the sand, is going to be a close below 277.40. Boeing. Okay, this is excuse me. This is definitely within striking distance. We have a new order block here. Why? Swing low, swing high, lower swing low, market structure change. Okay, this is a full order block. As soon as we have that market structure change, lowest closing bar prior to market structure change is the order block. Okay, there's our order block. There are no major moving averages inside this order block. However, I placed my own custom level in at 210.80. Why? Same as Apple. Here we have a V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. The key inherent support level is halfway of the number 2 bar. That's right there. That is the 210.80 level. So next week, as with Apple, if we do pull back, reject the 210.80 level, that would be potentially an entry for me. And then my end of bar stop, my line in the sand, would be a close back below 210.80. FedEx. All right. We do not have an order block associated with this particular trade, but I'm still looking for a confluence. Remember, I was talking to you about megaphone trend lines. Swing low, connected to a lower swing low. We connect those lines, come into the future. Well, look at that. The third time it rejected that key level, it did bounce. Now, I didn't take this trade. And in addition, we rejected the 200-day moving average. Then we moved up. Friday, we moved down. But, look at this contextually. This megaphone trend line is below us. And there's more of a chance it will bounce here because of the trend line than it won't. I mean, look, it could just slam right down through it, right? There's no guarantee whatsoever. But the idea at the moment is that this 200-day moving average, which should offer some type of support, is dovetailing with the megaphone trend line as well. So long and short of this, if we reject this trend line one more time and reject the 200 again, I would certainly consider taking the trade, and my stop would be a close back below that 200. But I just like the confluence of the trend line and the 200 being in the same location, even though we don't have a bullish order block, but it is a confluence. It's a confluence of the megaphone trend line and the 200 happening at the same time. If it happens, it may just take off and miss the trade, but that's what I'm looking for on FedEx. GDX, which is the gold miners. Gold miners have had a tough time over the last week. However, looks like something has changed a little bit, and it started on Thursday with the bullish abandoned baby. Look, we gap down, very bearish overnight. We gap up. So we went from bearish sentiment to bullish sentiment very quickly. That's the key. I didn't buy the entry here, but what's key is anywhere inside this abandoned baby now is some kind of key support. Friday we did bounce off the top of uh, the baby, which I literally that was a legitimate signal. When you have an abandoned baby and then you reject the top, that could have been the signal. But I didn't take the trade. But what I'm looking at the 300-day moving average here. This 300-day moving average, just a rejection of the 300-day moving average by itself is a legitimate entry. But I like that the 300-day moving average is living inside of this key level of the abandoned baby as well. So long and short, I'm looking for a rejection of the 300-day moving average that's dovetailing inside this bullish abandoned baby. If it rejects that 300 moving average key level, I would consider taking the trade. My stop would be a close back below the 300. IWM. Okay. IWM's holding in there a lot better than the SPY and the Qs, mainly because interest rates have been going down. But we do have an order block here, and there's two key levels within the order block. So if you want to look at what the order block is, swing low, swing high, lower swing low, market structure change, defines the order block, lowest closing bar prior to market structure change is this one, bring it into the future. So we have two key levels. The main key level would be, you see the V1 we have here, bar 1, bar 2, 2 goes under bar 1, closes above. Halfway of that is going to be inherent support. So that is why I have the custom level there at 285. In addition to that, we have the 50-day moving average, which right now is 284.57. You can see these two are almost kissing right here. The way that I would look at that, I would think that, okay, there's potentially some support because we have these two confluences of support. Doesn't mean they have to hold. And I wouldn't just take it because I got there. I would actually want to physically see it reject one of these key levels. But next week, if we do reject 285, I would consider taking that. My stop would be a close below 285. Or if we reject the 50-day moving average, which right now is 284.57, I would also potentially take the trade there. My stop would be a close back below whatever the 50-day moving average is on that day. But essentially, this is the area that I'm looking for a potential bounce. And I don't know if we're going to get there. There's certainly no guarantee we're going to get there whatsoever. But I'm just saying, if we do get there, then I'll look at that a little bit more carefully. WES, which is Western Midstream Pipelines. So, this is a petroleum-related company. We have a very nice order block here, and we also have a V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Where's the support? Halfway of the number 2 bar. Bring that into the order block. That's the key level. So there's two key levels that I'm looking at on WES. Potential rejection of the 100-day moving average right now, which is 41.93. If it were to reject 41.93, I would consider taking that and using the 41.93 as my key level, although it will change on Monday. That number will change, but right now it's 41.93. The one that will stay static is the 41.69. So if WES does come down or reject either of those key levels, I would consider taking the trade because it's a key level within a key level. But if it were to lose that level, that would be my stop. Walmart. All right. Been looking at Walmart pretty carefully. We have two order blocks. We have the higher order block, which is in the green. We have the lower order block, which is in the blue. We did reject the order block Thursday and Friday on Walmart. So technically those would have been legitimate entries, but there's no confluences there. That's why I didn't take them. If we go up higher and close above the 200-day moving average, that would be a legitimate entry. That would be a rejection of the 200-day moving average in an order block. If that happens, I would consider taking the trade depending on the risk to reward. Then my stop would be a close back below the 200. The one that I like better, honestly, though, although I'm not ruling out the first one, is this lower order block. The one that I have in blue, you have the 250-day moving average inside that lower order block. So if we do move lower and reject that 250-day moving average, right now the 250 is 112.72, I would consider that one. Or again, if we reject the 200 to the upside, I would consider that. So essentially Walmart either has to go up or down for me to get interested. And last but not least is XOM. And so it's pretty easy. We have a well-defined order block from the past. We have a 200-day moving average living inside the order block. And so really what I'm looking for, I'm just looking for a rejection of that 200-day moving average inside that order block. And the 200-day moving average is 133.77 at this moment. So, keep an open mind. It may get there, it may not. It may just take off from here and I miss it, and that's fine. But, if you watch enough things, eventually something will get to that level. So anyway, I hope you found these potential entries for next week interesting and the podcast helpful today. If you did, I really would appreciate it. You could hit the thumbs up button, really help out the channel. If you have any comments or questions, please put them in the comment section. I'll do my very best to get back to you and answer your questions. I hope you have a good rest of your week, everybody. Have a little relaxing time, do some fun things. If I can help you with anything, whether it's the 20-hour one-on-one course, please let me know. I also do private consulting. If I can help you something custom-wise in consulting, let me know. I help a lot of people around the world with trading. So I really appreciate you being here. And I always like to leave off with, if you have the ability to go out and do one act of kindness for another human being, if we all were to do that around the world, man, it would make the world such a better place. And I think the world could stand having a little acts of kindness going on at the moment. I'm also a very big animal lover. So if you have the opportunity to do an act of kindness for any animal that comes across your path, they appreciate acts of kindness just like we do. So I have a small little platform, but I at least like to, use my small platform to try to get a positive message out. So anyway, thank you very much, everybody. If I can help you in any way, please let me know. Be glad to do it. Love to have you as a student. And God willing, I will see you next week. So thanks so much for making it through the podcast. Appreciate you. And have a good weekend and have a good rest of your week. Take care.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.